Well, good afternoon, everyone, and thank you so much for joining us today for the symposium. The Appraisal Foundation and the Appraisal Institute are pleased to be hosting this joint valuation symposium on promoting trust in fair and affordable housing. This is the fourth and final session. I would say we saved the best for last, but I better not. They've all been good. So welcome. My name is Jeremy Gray. I'm the Director of Credit Administration at Rock Canyon Bank. And I will be the chair of the Appraisal Foundation, the Board of Trustees for the Appraisal Foundation here in the coming year. As a member of the lending community, I'm pleased to be moderating this panel for you and definitely excited to be participating in this important discussion about how we can promote trust in fair and affordable housing. We've had three great sessions if you've been able to join us for those. I do believe we are recording all those and will be available afterward if you weren't able to join any of the first three sessions. So we're glad to have you with us today. A few housekeeping items though before we get going. Please make sure your chat box is open. The staff will be sharing important links and you can submit questions for the Q&A portion of this panel through the chat feature. I will read your questions after each speaker's presentation. So if we don't answer them right away, just hold tight, we'll get to those, no problem. We also ask that you take a few minutes at the close of the session to answer questions in our brief survey about today's event. This does help us continue to ensure the best possible user experience for future events. And based on the information in the other sessions that I was in, it's been so good. I can't help but think this is one of those things that is going to snowball into something great. So we do appreciate your feedback. We are thrilled to have so many of you with us today and glad to have our wonderful panelists. We've got a great panel for you. They will have the Q&A session afterward. We do have a strict timetable, so no promises on getting to every single question, but bear with us. We'll do our best to get to every question that we can. Okay, let's get started here then. It is my pleasure and privilege to introduce our four wonderful panelists today. First up, we do have Krista Pate. Krista is the Programs Director at the Community Reinvestment Fund and Detroit Home Mortgage. After Krista, we'll hear from Dan Tacona. Dan is the Senior Manager of Single Family Housing Insights and Solutions at Freddie Mac. And then to wrap up and close the symposium after the Q&A with Dan, we'll turn it over to Kelly Davids, who is the Senior Vice President of the Appraisal Foundation, and Rodman Schley, President-elect of the Appraisal Institute. And they'll both provide a few final comments for us before we wrap things up. That said, I'm going to turn things over to Krista as she shares some of the innovative work she's been doing in Detroit. Krista, all yours.
Well, thank you, Jeremy. So, as Jeremy mentioned, I work for Community Reinvestment Fund, which is a national CDFI that does work all over the nation. And specifically, I'm located in Detroit, and I'm going to tell you more about the Detroit Home Mortgage Program that we launched in 2016. So the Detroit Home Mortgage Program was needed for a very specific reason. Back in the year of 2014 and before, we saw that mortgages were unable to be originated by banks. And this was largely caused by the events in the aftermath of the Great Recession, where Detroit bottomed out their prices and were sort of trapped in a cash cycle. So what we experienced on the ground here were a lot of investors who came in and were buying properties for very low dollar amounts, even $1,000 or less. And so as a result, we saw at that time that mortgages had dipped down to about 12% as reported by realtors for new purchases, and cash sales had increased to about 88%. Sorry, I'm having a little trouble. Okay, there it goes. It's a little delay. And so as a result, we also saw that home improvement loans, both conventional and FHA, were also being denied at a rate of 80%. And this was largely because there were no appraisals to support the larger sales. Again, we had turned into a cash market. So a group got together, a group of lenders, philanthropic partners, and some government officials to try to create a program that would become an intervention for the market. And so what we decided was to come up with a mortgage program that would infuse comparable sales into the market and also allow for home buyers to address some of the deferred maintenance that they were unable to get as a result of the decline of many of the home improvement loans. So what is Detroit Home Mortgage? This is what we ended up with and launched in 2016. We created a mortgage program that could be originated by several banks through a collaboration. And that program allowed for lenders to lend, participating lenders to lend up to $75,000 above appraised value. The buyer could use that loan in three ways. They could buy a move-in ready home, they could buy a home and renovate it, or they could refinance and renovate a current home to address any deferred maintenance. So how it works is that the borrower receives two mortgages. The first is the portion that they receive within the appraised value, and it goes on a fixed rate mortgage at 96.5%, very similar to FHA. And then accompanying that, there's a second mortgage that allows the client to solve the portion above appraised value. And that was fixed at a 5% interest rate. Other terms that we associate with this program were that it was only for owner-occupant homes, 1 to 4 units. The property had to be in the city of Detroit, had a minimum score of 600. Of course, we already talked about the 3.5% down payment, and terms were available up to 20 years. And of course, our banks waive origination fees, points, and PMI to make this happen. And we had a special edition, which was second mortgage hardship forgiveness. And what that is basically when a borrower incurs a hardship, the amount above appraised value, which is equal to the second mortgage, would be forgiven completely, which allows for the buyer to go into the market and really start to be able to negotiate. And I'll explain that in more details. So with this program, we also included some other features just to make sure that we had the right community benefit. We made sure that we educated borrowers on the program, how it works, that they were receiving the amount above the appraised value if they chose to take that out, about the hardship forgiveness that protects their financial health and prevents them from being underwater if they needed to sell their home in the case of a hardship, and also could prevent some credit impact. And then we also created a way for borrowers to easily control the construction process, being that many of the properties in Detroit needed renovation. So one, we had each of the banks go through their construction department and administer the construction process at no cost. And finally, we created a special role called a project manager, which you can think of as sort of a 203K specialist plus, that not only helped the borrowers determine if the project was feasible, but they also helped form a scope of work and helped vet contractors, and then stayed on after the bank closed the loan to ensure that the renovation was complete. So what we've seen so far as results to date is that more than 75% of the folks using the program are coming from Detroit, which is a great sign that we're really affecting change. If you wanted to see exactly how this looks from a mortgage standpoint, Again, recall I mentioned that in 2014, we were seeing really low mortgages. So you can see that from this chart in 2016, we saw our first increase as a result of Detroit Home Mortgage being a catalyst in the market. And from there, we saw incremental increases each year. Um, I apologize. I thought there was more to my presentation here. So we're coming up with a problem. Um, but I can just talk through it. So the way the program works, in particular, to get these results where you see increased mortgages in the market, in particular to help appraisers, is that the program itself allows for an extra negotiation period. Now, I mentioned that earlier, and what it really boils down to is how we trained practitioners to use the program. So we first started with training 300 realtors, and have since subsequently trained over 1,000 realtors since that time on how to use the Detroit Home Mortgage, in addition to educating our buyers. And what that allows for is for a home buyer to go and get a pre-approval from a traditional bank that they normally would have, and go shopping for a home. Now, when they shop for this home, clearly they're approved for an amount that may be more than what the home would appraise for. And so when they talk it over with their realtor who was trained on a Detroit Home Mortgage, the realtor would then know that they may have to accommodate that buyer and be able to come with a true valued home. And what I mean by that is when a Detroit Home Mortgage buyer makes an offer on the home, they may agree to a price. And for our purposes, let's just say $100,000, which is the typical price for a home in Detroit. And when the appraisal comes back short, meaning we don't change anything with the appraisal process, the buyer would then have an additional negotiation period. Now, that may sound familiar to many, but in this case, the buyer actually has a choice to say, Mr. or Mrs. Realtor, I would still like to buy this home, but I don't think it's worth the $100,000. Maybe I think it's worth a little less. Maybe you can show me some comparable sales that show me what I can start to have a conversation with the seller or the seller's agent about. And so because of that, that stage for the extra negotiation period, Detroit was effectively able to infuse truly negotiated sales into the market that appraisers felt comfortable using, because they knew that that conversation was happening. They knew that the buyers were educated. They knew that realtors were educated. They knew that sellers were educated. And they knew that folks were going to haggle over the prices. So that it wasn't a situation where we were saying, hey, you can use 75,000 above appraised value and it's a free for all. There was actually a stage for negotiation where the seller sets a price and the buyer may or may not disagree with that based on the appraisal. And so over time, we saw that infusing those comparable sales as sales were reported through the MLS, that the neighborhood values started to stabilize and it allowed for more traditional lenders to come into the market. So you can think of Detroit Home Mortgage much like a catalyst product where we go and lay the groundwork in order to help neighborhoods or reset or unlock values. I mean, that's really how the program works. Now, I did have some pretty maps to show you about how Detroit Home Mortgage actually affected the market year over year, but it's really reflected on this chart as well. And I can send the maps separately if the hosts don't mind. But we've seen increase year over year. And we are truly lucky that this year with COVID, that we have not seen that much impact to the work that we've done to build the mortgages up and values up in the market. We have seen that ideally by the end of this year, we'll be effectively at around the same place that we ended in 2019. So not exactly another increase for 2020, but surely being able to maintain the recovery that we've seen to date. So with that, I will turn it back over to Jeremy, who can um, take us to our next step here. Thank you.
Well, thank you, Krista. Dang it on those slides. Maybe we can include the ones that we're missing in the final piece that goes out to all of the participants. The slides that were there looked great. They say a picture's worth 1,000 words, and there's definitely some stories in those slides, Krista. So excellent job. Appreciate it. We do have a few questions for you. So let's see. Question from Paul. He asks, on home improvement loans, did you use the FHA Title I program, which ensures loans up to $250,000 without regard to appraised value? A couple follow-ups in there as well, Krista. Whose capital is the second mortgage? And what are the repayment provisions of the second mortgage at the time of resale if appraisals have not caught up with the overall debt? And I can go back to that first one and divide it up if that's too much mumbo jumbo in there.
Hopefully I'll remember, but if I lose my way, please redirect me. But for the Title I, so we pulled data on HDMA data to inform us on the state of the home improvement loans. So I believe that was included. If it wasn't included, then we really sort of leaned on the fact of the experience of the average home buyer and what we were hearing, which is effectively that anytime they went to visit a lender, regardless of their credit score or profile or employment history, that they were being declined because of a devalued home. And so that was really the catalyst and the start of looking for a particular intervention to try to change some things here on the ground. Regarding the capital for the second, the Detroit Home Mortgage is a fund, and we were very lucky in that when looking for investors in the fund, the very banks that are originating the program also decided to invest in the fund. Beyond that, we have even more banks come to the table who may not have been in an exact position to originate, but were very supportive of our initiative. So we had a total of 7 investors into the fund, and the fund investment was about $40 million, which would give us around 1,000 mortgages to be able to do in the market to spark activity. Now, what we saw was that we needed far less than that. So just a word of advice if anyone else wants to pitch this in their city, because as you know, once a true comparable sales are infused into a market, if they stay consistent, then it sort of eliminates the appraisal gap, which is what Detroit Home Mortgage was trying to solve for. So effectively, we put ourselves out of business in many neighborhoods way before we thought we would, which was a great thing. And likely we'll use only about 10 million of the 40 million that was raised. And you had one more question, Jeremy, that I think I forgot there, but I think it was related to capital.
Well, the question is, whose capital is the second mortgage?
So the investors are the banks. So I thought I covered that. But I believe your last question was regarding the hardship forgiveness and how that works.
Well, let me reread it for you. It says, what are the repayment provisions of the second mortgage at the time of resale if appraisals have not caught up with the overall debt?
Okay. Yep. So if a buyer incurs a hardship and they need to sell their home, they can submit hardship request paperwork to Community Reinvestment Fund, and then the second mortgage would be forgiven if they cannot meet the sale price for the home. So it will be completely forgiven. So there are no repayment terms. It would simply be forgiven. For example, if I was that same home buyer who bought that $100,000 home in 2016, and the neighborhood had yet to realize that stabilized value, and then maybe I incurred a hardship due to coronavirus and I needed to sell my home, and the most I could get was 70,000, then essentially um, the trade home mortgage would forgive the difference.
Okay. Another question for you from Van. Will we be able to get a copy of the presentation materials, which Krista did allude to that, and we'll work with Krista to make sure we get those missing pieces in there as well. We are recording this session, and that will be available afterward as well. So both of those combined. How about a question here from Kristen? She asks, can you talk more about the safeguard that protects borrowers when being underwater when they sell? I know you touched on that a little bit, but anything more to add on that one?
Yes, actually, I do have something to add. So again, we start with our buyers, or that conversation with our buyers, from the very beginning of their touch with the bank. So when they sit down with a loan officer at their traditional bank, they are going to be talking about Detroit Home Mortgage amongst other products the banks have. And so if they elect or are interested in Detroit Home Mortgage, they have training that they have to complete. So one, we take them through what's called high CLTV training, which is exactly what it sounds like. It's the training that sits them down for 45 minutes and walks them through what Detroit Home Mortgage means, effectively similar to the same presentation I gave today. But in the latter part of that training, they're going to go through a series of examples, explanations, etc., that center on the fact that to help them understand that they are still taking out a mortgage above appraised value and what that means. It also touches on the hardship forgiveness. It shows them a copy of it up front. And in addition to that, they are required to take even more training, like your traditional homebuyer education class, as well as a renovation class to learn the roles and responsibilities if they elect to renovate. And all of that is administered through housing counseling agencies. The CFPB did review our program up front as well to make sure that we had everything we needed for buyer safety. And so we do have 10 housing counseling agencies throughout the city who are administering the education and checking for understanding.
And you mentioned the CFPB. I'm thinking of the session that was right before us. It'll be interesting to see, with the new administration, what happens with the CFPB. I'm curious, Krista, as you talk about counseling and education, and because those are definitely pillars that personally I'm a strong advocate of. Have you seen any changes or any borrowers going maybe a different direction after that education, counseling, training?
We have not tracked the buyers who may have selected another product per se. But what I can tell you about the buyers who have closed and are, in their homes successfully, that we haven't had any defaults to date, even through the coronavirus. Now, we did have to stand up a payment deferment plan with the coronavirus, but much like any other lender. However, we haven't seen a significant amount of participation. So I think our education heavy program was the right thing to do, in the respect that it also seemed to help with folks really understanding how much they want to spend. Particularly when you're training the buyers to go in and negotiate, right? So I think that we are definitely very supportive of education in this process and feel like it was a key factor to the success of the program.
Good. How about a question from Jody? She asks, how have loans performed in the Detroit program? And can the presenter discuss successes and challenges with renovating homes? A follow-up question to that: has $75,000 been sufficient?
So I'll address the second half of that program because I feel like I touched and hopefully answered the question about the sustainability of the borrowers. But when for renovation, so one, the $75,000, the way that that was came about was that we worked very closely with the community. And so we have one of the largest land banks in the nation, the Detroit Land Bank. And they had, prior to our program, launched an initiative called Rehab and Ready in conjunction with Quicken Loans Community Fund, as well as Home Depot. And as a part of their process, they actually went and tried to scope out about 200 homes on Detroit's west side that were typical of the average home in Detroit. And from that research, they found that the average repairs or cost for repairs to a home that was vacant and owned by the land bank was $75,000. And so that's how we got that number. And since we used that as our number, folks have had enough money in order to renovate their home. And that's mainly because we allow for the program to go up to the conventional loan limits. So it's not just that the buyers are using the 75,000. What they're doing is approaching renovation and completing the deal. So for instance, let's just take that $100,000 example. I could either buy a home for $10,000 from the land bank and include $90,000 of renovation, and or I could buy a $100,000 move-in ready home or somewhere in between. And so what Detroit Home Mortgage does is really says, okay, you're buying a home. The as completed value is, let's just say 70,000 for our example to make it clean. You need a total of $90,000 to renovate your home because you bought it for 10, which will put you at $100,000. $100,000 is more than $70,000, leaving a $30,000 appraisal gap. Do you still want to elect to take out this loan, or do you want to try to rework some things, which is what the extra negotiation period allows for? And so in that case, we haven't seen any troubles with folks renovating homes. What we have seen are stalls and delays in the contractor industry, particularly because there's a contractor shortage here. The typical age of the home in Detroit is quite old, almost 1 century old in here, and all of the delayed maintenance and deferred maintenance from the crash that has been trapped in the cash cycle. And so we, as a community, are trying to find more ways to create move-in ready homes to try to fill the gap there. But renovating home is not easy, but particularly related to the program, folks are finding some success.
Good. Question from Van. Can you elaborate on Detroit Home Mortgage to impact property values?
Sure. So, so the way that it impacts property values is really through a move-in ready home and also vacant homes. So we've seen it impact directly and indirectly. So in the case of a move-in ready home, I've described how Detroit Home Mortgage allows for an extra negotiation period. And continuing with our example, say that, the seller offers or ask $100,000, the appraisal comes in at 70, and we agree upon $90,000. Well, if there's a realtor involved, that $90,000 sale is going to be reported to the MLS and is going to be available for future appraisers to use. And so you do that 2 or 3 or 4 or 5 or 20 or 200 times, then effectively you're going to start to see more stabilized values in that area and make it easier for appraisers to do jobs, which effectively makes it easier for buyers to get mortgages, which effectively makes it easier for more banks to come in and do traditional lending. In the case where buyers are renovating, so let's use our same example where I'm buying a house for $10,000. and I have, let's just say that $90,000 renovation. Well, in that case, the vacant sale home price would be reported to the MLS. And once you have a few or 5 or 10 or 20 or 200 buyers all buying property and renovating, then you're starting going to see the vacant home prices rising, which effectively, indirectly, as you all may know, helps prices rise overall. So hopefully that was a clear explanation with not too many numbers. You may have to play it back on the recording.
Circular flow. Love it. How about a question from Douglas? He asks, how has the appraisal process worked from a process flow? Get a conventional appraisal, fall short, then what? How about a second appraisal that allows greater comparison latitude to recognize the aspirational goal of the gap financing? Allows reaching back farther into history of sales, reaching proxy neighborhood comparisons, etc.
Well, the interesting thing about, let's start with the historical aspects of appraisals. So if you recall the first map that I showed you from 2014, there were only about 494 mortgages in the market for the entire city as reported by realtors. So when you're talking or taking that from an appraiser standpoint, it's very hard to find comparable sales if nothing else in the neighborhood matches. So for instance, there's a ton of cash sales that very low prices that are geared toward investors, and maybe you have a regular seller selling to a regular home buyer. So it made it really tough for appraisers to get their jobs done here. And in addition, the way that we approached the sort of appraisal debacle here is that we didn't look to blame appraisers, but we also didn't look to interfere with their normal processes. So we effectively didn't change anything about the appraisal process that has not already been instated. What we did was said that, for renovation, we would follow FHA 203K guidelines regarding the appraisal and produce an as-is appraisal per their normal processes. And that was really the only thing that we made sure to really call out in the program. Other than that, we used the normal conventional appraisal, and it seemed to work fine.
Okay, perfect. How about a question from Dale? And I know you alluded to this a little bit, but maybe could elaborate a little bit. So he asked, so under the forgiveness program, then is it the investor or the taxpayer that soaks that loss? Seems that if there are enough losses, we could be in a similar situation as in the early 2000s.
So thank you for asking that. So the fund incurs the loss, and we actually had a credit enhancement that was provided by the Kresge Foundation in order to cover those losses. So we wanted to make sure that home buyers who took this risk to help heal their neighborhoods had a safety net, a true safety net. So we did plan for that.
Perfect. Question from Roseanne. She asks, can you please explain in more detail the extra opportunity to negotiate provided to buyers and how that works?
Absolutely. So traditionally, when an appraisal falls short, maybe there was a negotiation period, but in Detroit, that negotiation period, it looked like the buyer and seller saying, and their real estate agent saying that this should have been a higher price, and taking that to the bank and doing an appraisal dispute. When you're doing an appraisal dispute, it rarely worked in Detroit's market because we just didn't have enough data for true comparable sales. We really just had a lot of investors coming to our market and creating rental property. That's just what we had in comparison to the few home buyers that were left and able to obtain mortgages. So from that respect, you were really looking at a situation where those comparable sales really weren't a negotiation period. It was sort of a please don't kill this deal type of conversation. But by introducing Detroit Home Mortgage into the market, it actually allowed for that conversation that happens after an appraisal may fall short to be effective, to say, what is the real price here? Do you have other sales that may have happened nearby? Do you have some sort of investments that are coming out nearby? Because our mayor has invested into many of our neighborhoods and redoing some of the corridors. It gave a chance for a buyer to say, explain to me why you asked for, X dollar amount when the appraisal came back lower. And if you can explain that to me, or I can explain that, or we can come to some agreement, it may not be your asking price, but we can still close that deal, and I can still buy the home.
Krista, one more question, and then we'll make sure we leave time for Dan. So we have one more question, and it's from Bill. And Bill, by the way, great to see you on the last session. He asks, on the point about building velocity in the market with new sales, have you run into any issues with subsequent appraisals adjusting for sales concessions with these soft seconds?
We haven't. And it's because Detroit Home Mortgage was designed to basically eliminate itself out of the picture and let traditional lending take a hold of the market. So although we've seen some improvement in our market, there's still a lot to do from the traditional lending standpoint. And so what you'll see is we have neighborhoods that use Detroit Home Mortgage, and the neighborhood negotiations and comparable sales have come out to be around 60,000. We've seen other areas in the city where, they might be the historic district and folks needed a lot more to renovate their homes, and the neighborhood price has reset at about 350,000. So we've seen a very large range here, and I can tell you, the lowest Detroit Home Mortgage that we've seen close to date with acquisition and renovation was 35,000. And particular to that, when you think about the overall progress in the market, we've only had 4 years of healing, and we were nowhere near where we were to be considered normal. So there's still more work to do. It's just looking at how many of the 201 neighborhoods in Detroit have sort of been penetrated by Detroit Home Mortgage and where traditional lending is going, and trying to track where we need to focus next to get that next neighborhood online. That's the difficulty, is trying to pinpoint that with a fast changing market.
Okay, well, thank you, Krista. We appreciate all your expertise and your wisdom there, and what you've done there in Detroit. And of course, thank you. It's always good to hear, real life good stories of the successes and things that make it work out. So we appreciate it. Thank you, Krista. Dan, you've been patiently waiting in the wings. You've been chomping at the bit. You are up, sir. Turn it over to you, Dan. You're on mute. There you go.
Okay. Can you hear me now? Okay. My mute button disappeared on me when we loaded up my presentation. So make sure that there we go. Okay, great. Well, thank you so much for the opportunity to highlight some of the community and economic development activities that Freddie Mac has been undertaking. We set out to think about ways to address housing supply issues, and the fact that, as you probably have read about or discussed about, there's no adequate housing stock overall, and much of the housing stock that is there is aging. And simplistically speaking, there are two general obvious ways to address the lack of housing stock. You can either build new units or renovate existing ones, right? And each of these approaches presents its own set of, I would say, well-known challenges, probably many of which you've discussed throughout the conference. As it relates to new housing construction, right? construction costs are rising. What we see from our vantage point is that there's limited entry-level housing stock. We see barriers such as limited inclusionary housing, outdated land use and zoning requirements. We also see changing demographics that is also changing the types of demand for, or the demand for different types of housing options, I would say. So senior housing, veterans, and or people with disabilities, I should say. And as it relates to updating existing housing or engaging in renovation activities, limited financing options tends to be a trend or a theme. Even though there are financing options available, just like the one my co-panelists just went through, there's still, overall a gap in terms of funding for rehabilitation activities, renovations, weatherization, and or building additional dwelling units, which is a topic that continues to be discussed about in different markets as a tool to address housing stock issues. We also understand a few developers are currently focusing on renovation projects and rehabilitation projects in general overall, right? And remember, we're looking at it from the vantage point of Freddie Mac and surveying the entire market. We're not, so this is more of a general theme that we're seeing, not necessarily particular to any one given market. We see also inadequate capacity and technical assistance for how to leverage city-owned land or properties, right? Again, my co-panelists just discussed how they're working with the Detroit Land Bank. But I would say that's not a model that is widely used, and we also see an opportunity there to expand that market. So one common theme that's probably of interest to you is the appraisal-related issues or appraisal gap issues related to depressed values. And what we're seeing is that happens to be true, especially in communities of color. So we set out to, let me see if I can advance this. There we go. Okay. So we set out to try to identify levers within, there are policy programs, initiatives, and products that we have, and also through our relationships in different markets to figure out how we could address some of these challenges that I just mentioned and identify levers that we could experiment with in order to drive our desired outcome, which is to create or preserve affordable housing stock more broadly. One interesting data point that I'll share is that we work a lot with the Center for Community Progress, and according to a report that they published not so long ago, and I'm going to read a little bit of what it says here. So vacancies skyrocketed with the Great Recession as the number of unoccupied dwellings rose from 9.5 million to 12 million nationally between 2005 and 2010. That number has declined since, but it is still far higher than it was prior to 2005. And other vacant units, which is a term used by the census to define units that are neither on the market, held for future occupancy, nor used only seasonally, have risen from 3.7 million in 2005 to about 5.8 million in 2016. So with this in mind, we decided to focus on redevelopment of aging stock and trying to establish partnerships with sources of properties and vacant land, like land banks, and focusing specifically on a few different areas, and I'll name a few: nurturing developers to encourage new development activity and redevelopment activities. I mentioned that one of our strategic focus areas was to leverage city-owned land or properties to be able to facilitate that development and redevelopment activities. We also thought through providing technical assistance on renovation projects for specifically for home buyers, and also leveraging shared equity homeownership as a tool to preserve affordability of housing over time. And we launched a few initiatives that, from our perspective and our view, have the potential to eventually be bundled together in the future. But for now, we've set them off sort of independently from one another. And I wanted to touch upon a few. On this page, you'll see a quick description of three of them. They're particularly focused on redevelopment activities. We launched the Developer Academy in partnership with an organization called Spark CDI, which is a nonprofit community development intermediary, and they are focused on economic development in Omaha. We launched this Developer Academy, and it is particularly focused on emerging minority and female developers that have a keen interest to give back to Omaha. Many of the participants actually grew up in Omaha, specifically in North Omaha. The other one that you'll see on this page is our vacant property conversion initiative. In partnership with the Center for Community Progress, which is a national nonprofit organization, they're focused on property revitalization. They especially specialize in land banking. And we also are collaborating with the Omaha Municipal Land Bank. And we launched an effort to redesign the land bank's disposition strategies to revitalize and redistribute properties that were within their inventory and they're owned by the land banks through shared equity programs. Therefore, we're aiming to keep those homes affordable over time. So not only bringing those properties back to into use, but also ensuring that as those properties are turned back into the market and to use, they remain affordable over time. And I'll go through how we envision that would work later on in the presentation. The last one that you'll see here is our Community Champion Initiative, which in partnership with Act Housing, which is a nonprofit developer and how-to-prove home buyer and counseling agency, which is located in Milwaukee. We launched an initiative that provides technical assistance with renovation projects to home buyers looking to purchase distressed homes that are within the Milwaukee city inventory. So if you're familiar with Milwaukee, they don't have a formal land bank, but the city does have powers by state level legislation that give them the ability to function sort of like a land bank without being a land bank itself. And under this program, what we're looking to do is connect home buyers to lenders that are within our network that can deploy our renovation product, which is the Choice Renovation Financing product, to finance renovation projects. Let's see, turning to the next slide. Oh, that's in. There we go. All right. So here I wanted to go a little bit more into detail about the Developer Academy. So we had two cohorts, one that started this year, and it was made up of 16 minority and women developers. I mentioned many of them grew up in Omaha and truly have a vested interest in developing their own hometowns, right? So they're coming back into the North Omaha area and other areas within Omaha and looking to influence change and develop and redevelop, or redevelop, I should say, some of the areas that have been historically underserved. And what you see here on the screen is a snapshot of the curriculum. We aim to provide with the participants with tools, knowledge, connections, and information that can assist them on how to successfully address some of the housing needs in Omaha. One example that may be of particular interest to you on what we cover under these Developer Academy is the importance of engaging appraisers early on in their development strategy and thinking process. What we know is that generally developers go in, start developing, and then at the very end, when they're looking to market properties and sell properties, and even sometimes when they're at the very end of the process at the transaction level, when they're looking to sell a property, that point is when they engage an appraiser. And then they have sometimes often false expectations that the property would appraise at the price point that they're trying to sell it at. And they have very little wiggle room because they've already invested and put in a lot of materials into that development, perhaps without having checked as to their ability to be able to sell, those homes for the price point that they were envisioned and that they would be able to do. And at that point, it's other than sort of taking a loss or trying to figure out how to subsidize, maybe the gap. There's there's limitations to what they can do. The house is already built, right? So one of the sessions that we have structured, and that is actually provided by our Freddie Mac's very own chief appraiser, who actually, I should say, grew up in with the Appraisal Institute and is a former appraiser, and at some point had his own appraisal company. He tells a story as part of the session that we've established that developers used to walk in with blueprints into his office and sort of put them on his desk and said, give me some ideas and what would be the values that I'm looking at for these properties. And then they would adjust their development strategy around that, whether it's how they're going to design those or working with the architects to design those developments ahead of time. That way they're actually starting from thinking about a price point before they've even broken ground. And, the story is a really good story because by doing so and starting early on in the process and engaging with the appraisal community or appraisers to start thinking about valuation at the very beginning of the process, you tend to mitigate to a certain extent, not necessarily eliminate, but you mitigate appraisal gap that you may encounter at the very end of the process, right? So one of the things that we hone in this particular academy, especially in that session that I just referenced, is to really work with the appraisal community early on before they even start, when they're thinking about planning and when they're designing some of the blueprints, et cetera. Which they have found that our clients are the developers, and they've found this concept, which may be sort of a basic concept to some, they have found it to be very, very, very useful. And many of them sort of he said, I should probably start doing that on every project that I work on, right? I should say that this is the first time that we've done this. Our first cohort of 16 is graduating at the end of this month. And the next step that we have is to collaborate with Spark CDI to actually build out a demonstration site in Omaha in 2021, where we hope that they will be able to apply many of the concepts that we have been covering throughout the curriculum. The next cohort is set out to start in January. What I would say to you is that, I would flag that opportunity in terms of to the extent that you have relationships with developers. This based on our participation in the market, tends to be a very welcome idea by developers that, although it may seem simple, it's actually very useful. So with that, the next slide here. Okay, so I wanted to also cover Community Champion initiative that I referenced. So here, it's actually fairly similar to a certain extent to the Detroit program that you just heard about, and that this is a program that is designed to focus on development activities. It is an acquisition and rehab program where we are connecting home buyers to properties in order to transform those properties that may be in stress into usable housing stock. And the challenge that we were looking to address is that we know, based on our conversations with land banks across the country and other, I should say, cities or local governments that may have organizations that function like a land bank, is that trying to dispose of properties to a home buyer is very challenging, right? As a home buyer, generally it's very hard to conceptualize a renovation project, right? And so what we wanted to do is having our choice renovation product available to finance renovations in general. We wanted to see how we can link our product, home buyers, our lenders, and an organization that can provide technical assistance to those home buyers that are looking to purchase properties that are within specific sources of inventory. And we theorize that by helping homeowners in designing project plans, we would further encourage and promote and facilitate redevelopment activity. Much of some of the success that we have seen in Detroit, we hope that we can implement a similar or facilitate and encourage similar constructs or transactions or structures and programs in other areas in the country, leveraging our own choice renovation product. Our community champion acts housing. They conduct the assessment on properties. They have access to that inventory ahead of any marketing of those inventories. And what they do is they actually, once they do the assessment of the properties, they draft proposed renovation project plans that also are in line with our choice renovation product requirements to make sure that the transaction will eventually work out and be feasible when it comes down to actually going through the underwriting process. And we bring lenders to the table to be able to actually do the loan. By doing so, we think that we're taking the burden off the borrower to think through and assess the property renovation needs. I myself just recently went through a renovation in my house, and I can tell you that it is not an easy nor fun undertaking to participate in. Many of you think of the average consumer. There's a lot of misconceptions and lack of understanding on renovation projects in general. So we think that this certainly facilitates transactions and the reuse of properties that are part of either land bank or city-owned properties. I would say that from an appraiser perspective, we hope that by providing this level of support and technical assistance to home buyers, you wouldn't be put in a position where a client, whether the homeowner, is questioning appraised value when the renovations are completed, right? Because a lot of it would have been discussed ahead of time. We have a third party that is actually doing the valuation at the very beginning of the transaction to make sure that from a financing perspective, that the transaction will work. So with that, let me go into discussing a little bit of what we're doing, how we're leveraging shared equity. And I'm going to shift gears a little bit and not necessarily talk about redevelopment or renovation activity for now. But I want to talk about shared equity homeownership as a tool that we're using to prevent community blight and deterioration. I'll start by saying that from our perspective, given the pandemic, what we're seeing is that there is a lot of hardships. And even though the CARES Act and both of the GSEs issued flexibilities to help home buyers retain homes, we know that there will be a subset of home buyers that may not be in a position to resume their mortgage payments as originally structured or take advantage of some of the policies that have been issued by the GSEs and also under the CARES Act. So with that in mind, what we wanted to prevent is having an issue where we're seeing a lot of foreclosures, and that's affecting property values, right? I don't think I have to describe to you what happens when a lot of foreclosures are affecting any particular market, especially from a valuation perspective, right? So we thought that we needed to come up with a innovative way to address that before it happens. And a lot of our commitment has been in the shared equity homeownership space. So we thought that that could be a tool to address a potential influx of housing supply that may be coming as a result of foreclosures. And before I get into how we conceptualize this, I wanted to start by describing very briefly what shared equity homeownership is, in case you're not familiar with those concepts. So shared equity homeownership it's a tool to address the affordable housing supply shortage as we see it. Basically, I'm referencing retail restricted housing, right? Usually inclusionary housing programs, or there's different models like community land trusts. There are leasehold type properties where basically an entity, whether it's a nonprofit or a local entity or local government entity, is essentially subsidizing the price of the property. And in exchange, they're putting retail restrictions that are carried on from resale to resale. So on this page, what you will see is a quick example of how it works, right? If you have a property which market value is about 200,000, the entity that is managing the shared equity homeownership program, what they would do is they would try to determine what a price point would be that would actually help a family of a certain level of income. And there would be a public investment into the transaction, and this example is 40,000. That would be a one-time investment that I like to call it the gift that keeps on giving, because through the resale restrictions, that $40,000 initial investment is carried out through transactions over time. And on the right-hand side of the screen, what you will see is how that generally works, right? The first sale and then the second sale, and those restrictions are there and sort of go with the sale. Even though the market value may be fluctuating, the affordable price is usually set by a static resale formula. So with that sort of grounding, what shared equity homeownership is at a very high level, it gets very detailed and technical, and I'm happy to answer your questions. Let me go to the next slide. As I mentioned, the problem that we're trying to solve for is that we expect that many homeowners will only be able to partially resolve COVID-19 hardships. We're specifically thinking of families of two, where one of the household members may not be able to resume a full-time job for a variety of reasons. We're seeing reasons that maybe sort of that childcare is not there, right? A lot of childcare and schools have been closed, so we're seeing families that are opting to one of the family members opt to stay home. Well, that has an impact on the income that family has been able to provide prior to the pandemic, and we're thinking that when they're in a position to resume their payments, they may not be able to resume their payments at the level in which they were able to sustain payments before. We're seeing that this is actually affecting, as you might have seen, that how COVID-19 itself is affecting, as an illness is affecting minorities the most. Well, that actually translates also into financial capabilities. And what we're seeing on the data that we keep surveying is that we anticipate that especially minorities that have been mostly affected by COVID-19 will require payment relief beyond existing offers, beyond some of the existing policies that have been issued to the market in order to stay in their homes upon expiration of the maximum forbearance timeframes that are set forth. So we conceptualize a shared equity conversion solution where a home buyer would be able to opt into a shared equity homeownership by transforming their property into a shared equity property in order to stay in their home. Looking at the time, I'm going to go right into the next slide that will tell you how that works, and I'll take questions. Essentially, as you may know, under the CARES Act and flexibilities that Freddie Mac and Fannie Mae have issued, borrowers have the opportunity right now to, for lack of any technical or to not get technical, pause their payments, right, for up to 12 months. And during that forbearance period, they're making no payments, but those payments are being accrued. At the end of that period, right, they have options to restate their mortgages, but they have to repay those monies, and they can engage into a repayment plan or have a deferment of the payment. And if neither of those work, then we do provide opportunities to modify the mortgage to a certain extent by extending the term of the mortgage, and therefore reducing or aiming to reduce the mortgage payments on a monthly basis. But we know that those flexibilities may not be sufficient for some of the borrowers, as we're seeing in the market today, especially those that, for example, think of the sample family that I mentioned, right? Family of two, where one is coming back to work and the other one is not for a variety of reasons. So in a normal environment, that loan will go into a standard short sale, deed in lieu, and eventually foreclosure, which is basically the borrower will have to give up their home. What we're building out is a new concept process where that borrower that may not qualify for a restatement repayment or a flex modification would have the opportunity to sell their home to a shared equity homeownership organization. The shared equity homeownership organization at that point would purchase the property, they would transform the property from a fee simple property into a resale restricted property. And then they would price that property based on the borrower's affordability threshold. And at that point, they would resell the property right back to the same borrower. So theoretically, and we're building this concept out right now, that would all happen simultaneously at the closing table. So the borrower actually would not have to turn in their keys. They don't have to worry about that, and they would get to stay in their homes. As you can imagine, there's a ton of details behind this, but we think that it is a very innovative solution to try to address a potential crisis that we may have in our hands in terms of a foreclosure crisis that by where there would be properties going into the market that are abandoned, and therefore values would be affected as a result, especially in particular markets. So with that, I'll pause and take any questions.
Well, thank you, Dan. A lot of good information there, and those slides were really, really good. We do have a question as far as getting a copy of those slides afterward. Do you think that's going to be possible?
Yes. I think the one copy that I sent you, I'll probably just need to rerun it by our teams, and we probably can send a copy. But let me double check on that.
Okay, appreciate that. Yeah, when you were talking about the renovation and the consumer, Dan, I felt like you were talking straight to me. The consumer not knowing what the heck he's doing when he's trying to do some of those renovations. I had to chuckle. But on a serious note, you do mention a little bit ago about appraisals and possibly getting the appraiser involved earlier in the process. I guess, in thinking about that, how important is it to get, the appraisers involved earlier in the application process?
Right. So, when we started engaging with different stakeholders in the markets that we're working in, that appraisal gap issue kept coming up in a variety of different ways and forms. And we believe that by engaging an appraiser early on in the development process, the developer can start thinking about pricing ahead of breaking ground, like I mentioned, which gives you a set of information that is important in terms of choosing materials, choosing the development finishes, right, and everything and amenities that you may want to incorporate into that development, knowing what the price point that you're eventually going to have to work within, right? I think our collateral team always reminds me and some of the other business folks that are working through in development activities that it's all about location, right? I mean, you can build a beautiful property, but at the end of the day, depending on the location, it's going to drive a certain value. And what we hear often is the developers don't sort of seem to understand why the beautiful sort of property and with green features, et cetera, the value may not be, to what they expected. And a lot of it is really driven by location. So we encourage developers and all the initiatives they're doing to make sure that they are thinking ahead and engaging the appraiser community ahead of time so that they can have more informed decision making as they're moving forward with the development. Again, it's not a solution that would eliminate any appraisal gap issues, right? There's a variety of different underlying challenges related to appraisal gap, but it is a way to try to mitigate it and make more informed decisions about building and construction.
Good. We do have a question from Roseanne. Roseanne, thank you for your questions today, your participation. She asks, what kind of infrastructure already exists or is Freddie helping to build up to enable the shared equity solution to work?
Great. Yes, so Freddie Mac currently has shared equity programs and offerings. So the infrastructure to purchase loans that are secured by shared equity homes is there. Specifically, we have programs that help home buyers purchase properties that have income-based resource restricted or restrictions that are being sold through inclusionary housing programs. And we also have a program which is our community land trust mortgage, which is designed to help home buyers purchase properties that are within community land trusts. So those pipelines are there. So basically, as we put together this structure, we're leveraging existing pipelines that we have, an existing relationship with servicers and lenders that are currently participating in this market to make our concept work.
Okay. Question here from Michael. He asks, has the shared equity program been approved conceptually by FHFA?
Yeah, great question. So we are bound by a lot of different regulatory compliance matters. FHFA is a regulator. Our shared equity programs, both of them that I just referenced below, have been around for a while. Those have been approved by FHFA when we issued them to market within the last 2 years or so. As we work through this construct, they are aware of what we're building out. It's not necessarily a new product. It is leverage in an existing product. So from a compliance standpoint, we're not building a new product. What we're doing is actually leveraging an existing product and our partnerships to make a transaction work. Nevertheless, we are in ongoing conversations with our regulator as a matter of normal business to make sure that they're aware of all the different pilots, offerings, and anything that we may be doing.
Okay. Thanks, Dan. One more question, and then we'll make sure to leave a few minutes for Kelly and Rodman. The last question is from William. And there's a few questions in here, but he says, talk about the valuation of a resale restricted ownership. Also, can the homeowner buy back fee simple over time? Also, who funds the equity share? How likely is this to be implemented?
Great. All of great questions. So the first one was about the valuation. So we have very specific guidelines to manage the valuation under our collateral valuation requirements in our guide. In short, we utilize a hypothetical condition of value. When we're purchasing loans that are secured by properties that have resale restrictions, one of our requirements for the lender is to add a rider to the resale restriction document. That essentially what it does is, in an event of default or loss, in a loss event, after we have provided all the different appropriate rights related to right of first refusal to the organization or entity that is managing the shared equity homeownership program, and those have been exhausted, and we are in further down in delinquency where we would be in a position to take over that property. Our rider will extinguish those restrictions. So therefore, the beginning of the transaction and the originations point, we ask the appraiser to utilize the hypothetical condition of value in order to value those properties, which ends up being working out for the transaction as a whole. In terms of how likely it is to work, we've been working on the proof of concept for about 3 months or so. And so far, even though challenging, all of our stars have been aligning. One of the biggest challenges that we knew we would have to overcome going in was related to one of the questions, which is, where is the subsidy coming from? The first demonstration site that we're looking to implement this on, the local government is actually coming up with the subsidy amounts, because what they're looking at, they're looking at the equation between Do I want an influx in foreclosed properties and therefore deal with the consequences of that? Or do I want to invest now, right, to facilitate preventing that? And the math actually works in favor of doing proceeding with our program. So the money is coming from, in the case of the first demonstration market where we look forward to deploy this, is coming directly from the local government. Right now, all systems are go to deploy this sometime at the end of March, which coincides with when we expect the first wave of 12-month forbearance plans to end. We will continue going through our concept development and feasibility analysis. And when we know that this will certainly be a program to be implemented, we do plan to make appropriate announcements.
Thank you, Dan. Appreciate you sharing some of your day with us and some of your insights. Clearly an expert in his field, and so thank you, Dan. Appreciate that. I do apologize. We didn't have a chance to get to all of the questions, but I did want to leave a few minutes for our final two panelists today. And with that, Miss Kelly Davids of the foundation, I will turn it over to you.
Thank you, Jeremy. Wow, those are hard acts to follow. It's inspiring to hear about the innovative work that Krista and Dan are doing for fair and affordable housing. Their insights and the thoughtful conversations we've had over the last 2 days are significant, but this is just the beginning. Here's what you can expect from the Appraisal Foundation as we look to the future and work together to continue to uphold the public trust in the appraisal profession. Erica, I think you have my slide. If you could share it now, that would be great. If not, I'll keep talking. Let's start with the Appraisal Standards Board. The ASB is consulting with experts in fair housing related appraisal issues to figure out how to better guide appraisers about being aware of how bias might creep into their appraisal. Part of this work will involve the ASB review of Advisory Opinion 16. This fair housing opinion was last edited in 1998, so the board will be looking to determine if additional guidance would be helpful. As an aside, USPAP originally mentioned the terms bias or unbiased 3 times. The current USPAP publication mentions those terms 64 times. We've recognized the need to focus more and more on guidance in this area. The Appraiser Qualifications Board is also in high gear. While the AQB has highlighted these issues in required education courses before, it is working on changes to the criteria to add additional content on fair housing and bias, both in qualifying and continuing education. And the board recently adopted the practical applications of real estate appraisal. It shatters a barrier of entry to the profession by providing an alternative pathway to gain needed experience through simulated training. Our commenter from the last session who said that they were having struggles finding a supervisor, we're hoping to solve that problem for you very soon. Together, the ASB and the AQB are undertaking a major project. They're updating the 7-hour national USPAP course that appraisers take every 2 years to include an increased emphasis on building appraisers' awareness on recognizing and combating bias that can potentially sneak into the appraisal process. They are doing this through case studies, through incorporation of current topics, and they're going to offer some solutions. Equally engaged, Jeremy and the Board of Trustees has focused this year on issues of diversity and inclusion. Since forming in February, the Special Committee on Diversity and Inclusion has been working on activities to make the foundation and the appraisal profession look more like the America we live in today. They're helping to illuminate pathways to success for veterans, minorities, and others who seek a career in appraising. They're working with the AQB and historically Black colleges and universities to have their programs approved through our real estate degree review program. They're working to seek diverse candidates for our 3 boards, and they are building partnerships with corporate leaders to advance all of these initiatives. The energy is tremendous around these issues, and we are very pleased that hundreds have joined us for this symposium over the last 2 days. This is a challenging time for the appraisal profession for sure, but it's also one of opportunities. Over the years, the foundation, our 100 plus affiliate organizations, and appraisers across the country have joined together to find solutions for the problems facing our profession. By staying true to our mission, we are in the best possible position to lead tomorrow. While the topics covered during this symposium over the last couple days can be tough, I know that we together will rise to the challenge. Together, with appraisers helping appraisers, we will work to find solutions for the issues of today and for generations to come. This symposium is the first of these collaborative efforts, and we look forward to such conversations continuing on many fronts. Before wrapping up, I want to give a special shout out to the American Society of Appraisers, the American Society of Farm Managers and Rural Appraisers, the National Association of Realtors, the National Society of Real Estate Appraisers, and the Royal Institution of Chartered Surveyors for standing with us as event partners for this symposium. I also want to thank our behind the scenes crew for their work to bring this event to you. Erica, Amy, Aida, Joellen, and Jalen, we could not have done this without you. Thank you so much. Rodman, you're last, but definitely not least. The foundation truly appreciates this ability to collaborate with the Appraisal Institute to bring this symposium together. I'll turn it over to you now for your closing remarks.
Thank you, Kelly. So we've learned a lot this week, but this is really just the tip of the iceberg to combating potential bias and discrimination in fair and affordable housing. There is so much more to discover on issues like unconscious or implicit bias, or the possibilities of creative financing, which are just two that we heard about today. So moving forward, we have a range of initiatives underway that are serving as starting points on these endeavors. We have several seminars under development on bias and fair housing. The first is a joint industry-wide webinar that we're co-hosting with several appraisal organizations that are recognizing combating unconscious bias. This will bring the knowledge and expertise of non-real estate professionals directly to real estate valuation professionals, and we're doing this for free. You can look for that event, which is scheduled for January 13th at 2 p.m. Eastern Time. Also under development are new or updated seminars on combating bias in valuation and fair housing as it relates to appraisal. We've seen it here this week that these issues are not just matters of fair housing, but that potential bias and discrimination are important to take square on to enhance the credibility of appraisals. So look for more information on these educational opportunities in the coming weeks and months ahead. In terms of enhancing ethics, we're working on guidance on bias, which is also under development by our professional standards and ethics committees, as are enhancements to the AI Code of Professional Ethics. Much work has been done in this area over the decades, but much more can be done, particularly in helping to illuminate and illustrate the situations that might confront appraisers. We've seen that there are policy considerations that are helping to shape relative to underwriting and appraisal guidelines within agencies and enterprises and in the area of fair housing enforcement. The Appraisal Institute will continue to stand at the forefront of these discussions and develop solutions that focus the great knowledge and expertise of our practitioners to the matters of community and economic development. In terms of leading the profession, anything we do must stand the scrutiny of time and have lasting impact. We've not talked about it much here, but we have also much work to do to diversify the ranks of appraisers. We're working relentlessly in this area through the Appraiser Diversity Pipeline Initiative and the AI Education and Relief Foundation, just to name two. But there's so much more that we can do and need to do. As we say, appraisers reflect the market. To say that with more credibility and authoritatively, our profession should also look like and comprise the market. We'll all be better off by tackling these initiatives as we have here, together in lockstep with industry leaders and the stakeholders. And I would also like to say thank you for the AI staff, particularly Bill Garber, who has put together so much time and energy in collaborating with the Appraisal Foundation to put together this symposium. It's efforts like these that help the industry as a whole. When we can come together, look at the things that are impacting our professionals and strive every single day to be better. So Kelly, thank you to you. Thank you for all the efforts that came from the Appraisal Foundation in putting this together. We are certainly all much better when we're working together. And thank you to everybody who's attended today.
Well, thank you, Kelly and Rodman, for those closing comments. We sure appreciate it, and you can see there is a lot going on in the profession, both at the Appraisal Foundation and the Appraisal Institute. And I agree with Rodman. Working together and working through some of these issues and leading out is definitely the way to go. And so, just a big thank you. And of course, for all of those viewing this, thank you for joining us today. We appreciate your time, you spending part of your day with us. And of course, thank you to our wonderful panelists, Krista, Dan, Kelly, Rodman, great job. You can see there's all 4 sessions were just packed with a lot of information. And I would definitely consider this symposium a success and would anticipate more events like this to happen. This has been really great. Just one last reminder, if you haven't already, if you'll go in and fill out the brief survey, we'll read every single comment that comes along in there. So we certainly would welcome your feedback for that. And with that, just a big thank you for participating in the symposium, and please stay safe out there, and Godspeed everyone. Thank you.